Interest rates are higher than they've been in years. And is there a chance they might be lower at some point? What strategies could you use when volatility is high or lower? So this week's cherry picks, Mike Reckentine and Nick Batista, start off with showing a really good visual for interest rates in the treasury product. T-bills, short-term treasury bills to long-term treasury bonds out to, let's say, 20 and 30 years. What you can see, they show you a grid of numbers. The graph of those yields is where you should take a look at. The 1 month, 2 month, 3 month, 6 months are all much higher than the 20 years and 30-year bonds. The 3 month T-bill is trading over, let's say, about 542 or something like that, and the 30-year T-bond is yielding about 4.43 or so. Why is that happening? Well, people are afraid of short-term interest rate hikes or inflation. That's why the yield curve is setting up this way. Typically, you see the shorter-term maturities, 1 month, 2 months, are lower than the back month. And that's a more typical term structure or yield curve you see. But right now, the short-term interest rate products are much higher, and this is why your CDs that you might be invested with in your bank are getting such high returns at this point. Looking at some of the data out there, not so much in the August FOMC meeting, but in the September and November meetings, the probability of a rate cut is fairly high, about 70%, 50% for November. We might not see these high short-term yields continue as high as they are. Well, if you're getting decent returns on CDs, great, but it might not last long. That's why you should start to look at some other alternatives for your money, different option strategies. The guys also point out some really interesting things going on, the big movers in the NASDAQ 100. Starbucks, Tesla, and Qualcomm all jump out because of their high IV ranks. I know some of those stocks. Let's take a look at the platform really quickly. Let's look at Starbucks. Starbucks has been getting crushed. Why? I don't know. He's just been getting whacked here, and 101% IV rank. That's impressive. That's because earnings are coming up in early August. Going to Tesla. Tesla has had a massive rally, and again, earnings coming up in late July. Tesla, massive rally up over the past couple of weeks. Qualcomm, relatively flat here, had a sell-off in late June, mid to late June, but has bounced back a little bit. But a 99% IV rank, meaning its options are very, very highly priced and could present decent short premium or opportunities in these options for short premium. Just out of curiosity, looking at Qualcomm, $207. Let's look at Starbucks, a little cheaper, 72. Tesla is 264, an expensive stock. Let's look at Starbucks just for the sake of argument here. Stocks sold off massively. If I go into the August expiration, stocks trading about 72 or so right in between 70 and 75, close enough for me. If I go down 5 points from 70 to 97 to 65, that puts trading about 97. If I go from 75 to 80, 5 points higher, the call is trading about $1.29. So we're seeing a fairly deep skew pointed toward the upside in there. If you were bullish, if you were a contrarian trader, you might consider a bullish strategy in Starbucks. You could sell maybe the 65 put or something like that in Starbucks. Let's go back to the cherry picks, though. The lowest IV ranks are stocks like Intuit, Marvel Technology, Adobe, things like that. And those make it a little bit tougher for short premium strategies, and we bias it towards long premium strategies, not buying out of money calls or puts necessarily, but strategies like diagonals, verticals. We're going to take a look at one at the end of the video on a different stock. One stock that has been getting crushed is Walgreens Boots. It's a dog. Go back to the platform and take a look at a chart on that. And again, this is what I use charts for. I don't necessarily look at charts for whether the stock's going up or down. It's just what it has been doing, and had a massive sell-off here and has been sort of just drifting lower for the time being. 60% IV rank, I think it is no earnings coming up. Like the guys say, why is Walgreens doing so poorly? Poor management, competition, operational issues, supply chain issues, who knows? We've all seen those issues stated. Right. And this is the sort of thing where even though all this information is publicly available, anybody can look at it. Does it really matter? The only thing that matters is the stock is getting crushed. If you're bullish on it, yeah, with a high IV rank, you could sell a put. You could stand in front of that and say, okay, yeah, I think Walgreens is going to bounce at some point. Maybe. But that's just a choice you have to make. And it doesn't mean that it's going to go higher. It doesn't mean it's going to continue to go lower. But just use the information that volatility is telling you. The market is pricing in uncertainty. Options are pricing in a 16% move either up or down over the next 30 days. That's pretty big. And this is the probability cone that they've added to this chart of Walgreens. So yeah, if we go back in and look at some of this stuff, let's look at the August expiration. At $11, there's not a lot of premium in these options. I mean, the 10 puts, you could sell the 10 puts, I guess, but you're only making about $18 for a 982 max loss and a $351 buying power requirement. I just don't see Walgreens as a great trading vehicle right now simply because it's so cheap. Yes, for smaller sized accounts, cheap stocks are good opportunities because the margin requirements aren't so high. Really, there's not enough premium in here to make them interesting, in my opinion. Even if you go out to, let's say, 44 days. Yeah, maybe. I don't know. Let's look at something more interesting, though. A couple of trade ideas the guys point out. Here is one Shopify with a very high implied volatility. So high implied volatility means the option prices are higher than they would be, all other things being equal, and you get rewarded for taking risk when volatility is higher, when you sell options, okay? So Shopify has a healthy IVR of 66%. Sitting near the lows of its 52-week range. If you think it might bounce, to stay range bound over the next couple of weeks, short 60 put is around $2, only $5 of theta, and use around $700 of buying power. Let's take a look at Shopify. And Shopify, again, $65, so it's not a very expensive stock and can create some decent opportunities. It's been stuck in a range here. Earnings coming out for Shopify? Yeah, earnings are coming up on August 7th. Let's take a look at something in here. Let's look at the August options, and let's see which way the skew is pointed. So the stock is trading at 65. Let's go down 10 points and up 10 points. 65, the 55 puts down 10 points. So the 55 puts are trading at 108, up 10 points to 75. Calls are trading at about $1.80. So yeah, there's a pretty steep upside skew on Shopify. The low it's been, they're talking about selling the 60 put. Yeah, you could sell the 60 put. That's certainly a decent trade. If I sell that put, it has a max loss of $5,768 if the stock goes to zero. That's what the number is. Buying power effect's about $3,000. This is for a cash account if you're looking at that. Theta is about $5.40 a day. Not bad. In the P50, the probability of making 80% of the max, or 50% on the max profit is 81%. So max profit is 231. There is an 80% chance of making $115 on this trade at some point between now and expiration. This is assuming you want to take risk through earnings. Earnings are coming up, says here, on August 17th. And looking at the August options, you have to be willing to hold this position through earnings. If you are willing to do that, if you are bullish on Shopify, the 60 put, even the 55 put is a potential trade. If you want to give yourself a little bit more room to the downside, the 55 put generates $3.90 of theta, has an 89% probability of making 50% of its max profit, so $50 here, half of 106. Yeah, either one of these is a good way to do it. And as I said, when volatility is high, with a 70% IV rank and the 60% overall IV here, when you sell options, you are being rewarded for taking risk. That's why I look at short premium strategies when volatility is higher. Let's go down to the next one they have is Mara. Mara is one of the high beta names to play the Bitcoin space. Great. If Bitcoin's down to the lows, yeah, and you think the risk of the downside is over, an upside plan Mara would fit the assumption. So let's take a look at MARA, 5.7% IV rank. Okay, that's why they're looking at long premium strategies. And on a chart, yeah, it's been drifting lower. It's actually has been pretty range bound for the past couple of months. If you think it might bounce back up, what they're looking at is a diagonal where they're buying, let me make sure I get the strikes right here. They're buying the September 20 call and selling the Aug 24 call. So they're buying this call and they're selling the August 24 call. And this is a diagonal. Why is it called a diagonal? Because traders aren't the most creative people in the world, and what we do is say, well, it's across time. In other words, from August to September is across time, and the strikes are different, so that adds a certain tilt to it, okay? So it kind of looks diagonal, okay? That's about as much as you're gonna get from a trader. This trade, you're paying $274 in premium for this out of the money call. Not bad, okay. You know, again, IV is low, but on the other hand, you're only getting about 80 cents for this call. I might be a little bit more aggressive with that short call and sell maybe the 22. Collect about 40 cents more in premium. What does that do for me? It lets me cut down about 35 or 40% of the premium on this 20 call. You could potentially move this down here to the 17 strike, and you'd be paying about $2 of premium there, and you take about half of it off by selling this 22 put. With a diagonal, so this is a bullish trade, you have positive deltas here, you have positive theta. Yeah, I like these trades. P50 is 85%, a little bit harder to calculate the numbers for diagonals, but the point is, this is how you trade low IV. I'm buying premium in the back month, selling premium in the front month, and the reason I'm doing that is the reason I want to buy premium back out in September is that if volatility does increase, I have a lot of Vega. I have a lot of positive Vega that would benefit the strategy if volatility goes up. So if volatility is low, I'll buy some premium in the back month. If volatility goes up, and if the stock cooperates, I might actually make some money on the trade. With a diagonal, I'm going to wait. I'm going to hold on to this September call, whichever I buy, the 20 or the 17 or even the 16. And I'm going to wait until this short August option, August call, decays. I'm going to buy this back when it has about 20 days to expiration, and I'm going to roll it the August weeklies, and in doing so collect some extra credit. Okay, when I collect that extra credit, that whittles down the debit that I'm paying for this diagonal, paying for that extrinsic value here, and increases the probability of making money. So again, these are two trades, both Shopify and the Mara. The Mara only requires about $283 of theta. If you buy the 20, it's about 157. So this is an interesting trade for an $18 stock. Again, not much more expensive than Walgreens, but has a lot more opportunity to it, I think. Mara is good for smaller accounts. Let's look at that Shopify trade. Again, that's a little steep if you're looking at margin requirements, but you could potentially hedge it off by buying the 50 put as it is. So sell the 55 or sell the 60s, buy the 55s. Margin requirement for that's $371 only. Max loss $371, and the max profits $129. Those are two trades, two different volatility scenarios, and those are how you spin a strategy for each one of them. If you want to get these cherry picks delivered to your inbox every week and my daily cherry bombs with trade ideas, click on the link below.